So I'd like to welcome our speaker, Dominic. Dominic is an associate at Ripple Ventures, and he's done a lot of work with the DMZ community, especially with our Sandbox and Basecamp companies, who have really appreciated his guidance and advice. Dominic previously worked at KPMG and shifted into venture capital, where he's been working with a number of early stage companies as part of the Ripple portfolio. And he's here to share some really great information with you guys about the current climate and what that means for your businesses. So without further ado, I'll leave it to Dominic.
Awesome. Thanks, Emily. So yeah, as Emily mentioned, I'm an associate at Ripple Ventures, and I've had the great honor to be able to work with DMZ companies over the past couple of years. First, the Sandbox program, and now we've invested in some of the accelerator companies as well. So it's definitely a great place for founders to go, and we've definitely gotten some great investments out of that space. So the agenda for today, we're going to be talking about what the hell's even going on today with the coronavirus, how that's impacting you as founders, and why you should care in the first place. And we'll talk about some key things that you can do to plan ahead and try to mitigate some of the risks that are going on as well. And then at the end, I think we're going to open up for some Q&A and go through some questions that were submitted through YouTube, and then we'll go from there. So what's been going on? So as everyone knows, coronavirus has had a huge impact on everyone's daily lives. So the way that we go out and do business, to the way that we go buy groceries, and the way that we hang out with our friends even, there's been a huge impact globally, and even on supply chains where people can't even go back to work full time if they're hourly workers. There's been a huge level of uncertainty on how long this is going to go on for, as well as how bad it's going to be. Far, the human impact has been huge. So we did this presentation last week, and already the number of cases has doubled worldwide, and a lot more people have lost their lives. So it's been a huge negative impact on kind of the human population as a whole. And hopefully we can all do our part to kind of flatten the curve and get back to our normal lives, as well as make sure that everyone's safe and healthy. So the market has been on an 11-year bull run. So what that means is that the stock markets have increased and increased over the past 11 years. The only other bull market that has lasted this long and even less was the post-World War II run, as you can see kind of in this area of the stock market. So it's been a great kind of decade plus of increased value, but now we're heading into what it looks like to be a downturn in the market. So if you dive a little bit deeper into the mechanics of this, we're sitting around 25 to 30% drop in the markets. In the previous 2008-2009 financial crisis, it was around 40% drop, and the last dot-com bubble burst was around a 45% drop. The one thing to note is that the two other drops that have happened previously were over a span of around 2 years. We've gotten around similar value lost within a month, and that's because the markets hate uncertainty, and there's been a lot of panic selling that's been going on. So humans are programmed to go against losses and trying to mitigate as much as possible. So there's been a huge global sell-off that has created a huge downturn in the stock market value. And this is definitely going to trickle down to everyone, even if you're not a public company. So where's this going? Nobody actually really knows. But McKinsey had a pretty interesting report shown out. So I'll send Emily this presentation so that they can be distributed to everyone afterward. But there's three main scenarios that could actually turn out. So the first is a quick recovery. A lot of people don't think that this is actually going to pan out because of the way that the cases have grown so far, and also how it took China a couple of months on full lockdown and quarantine to kind of plateau their cases. And even now there are some new cases out of that region. So it's still very unlikely that we're going to have a huge quick recovery and a V-shaped kind of return in the market. What people think is probably going to happen is a global slowdown. So This could persist for 6 to 12 months, and there's a less effective response from the healthcare system. The supply chains take a little bit longer to recover, and people have a huge change in daily behaviors. And this is kind of like a U-shaped recovery over a shorter period of time. And the worst case scenario is that there's a huge kind of global pandemic and recession where there's a lot of people that get impacted worldwide. It takes a very long time for people to kind of recover, and it's more of an L-shaped recovery where we're in a downturn for kind of 12 to 18 months, and it takes a while to kind of get back up to speed. So the best case now is to take steps to prepare to make sure that we can set our companies up for success as well as kind of weathering the storm. And we'll talk about that today in the presentation. So as founders, why does this all even matter to you? You might think, hey, these are huge public companies who kind of are in a separate world than us. But you have to realize that these public companies and the stock market, they're all kind of intertwined with the entire kind of business and financial ecosystem that will eventually impact you. So we'll talk about a couple things in the trickle down effect in this section. So as a founder, you have to think about where the investors, as in your VCs, get their money, as well as your customers / your users, where they get their money. So VCs primarily get their money from family offices, fund of funds, corporates, or institutional investors like endowments, for example. For customers, they get cash from kind of sales. They get it from public markets, debt markets, and other sources. So how do they get their money to spend on resources and tools that you're offering? So if the market's in a downturn, it'll definitely trickle down to any company, regardless of size, whether it be your ability to raise capital or your ability to generate new revenues from existing or new customers. So those are the couple of implications that we expect to happen. So to dive a little bit deeper into this, from a venture capital side, the investors into VC funds have their portfolio shrink because of the market crash so far. So for example, if you're a family office and you have $100 in total asset value, and $70 of that was invested in public equities and $30 was allocated to venture, and that's the target allocation that you have. Well, if now that $70 in the public equities is now worth $40, that means you have to reallocate some of the dollars that were meant for venture back into public equities to balance your portfolio to hit your target allocation size. And that means there's going to be less money to invest into venture funds, which means the venture funds will have less money overall to invest in startups. There's some VC funds out there that have raised recently and closed funds, but there's word out there that some investors are asking them to not do capital calls. So how venture funds work are they kind of get capital committed from their investors, and then every time they do a deal, they do capital calls. So they call money from their investors. So in this case, if the capital calls need to be gained in order to liquidate positions in the public equities market, so their stocks at a huge discount, that's probably not an ideal case for the investors into venture funds. So there's some signal out there for some people saying, hey, don't make any investments yet, just because we want to kind of preserve our capital and we don't want to kind of make any sales yet. But obviously there are some funds out there that are still extremely active and making investments throughout this crisis. So I'm just kind of giving some perspective on both sides. So there are definitely funds still making investments. And the other things are around kind of the higher bar for investing, because the return profile for exits and returns have changed. So if you think about how these businesses make acquisitions, it's either through cash or through stock. So if let's say like Salesforce is buying your company, and Salesforce, let's say, is down kind of 20%, for example, the value of their shares to buy your company is much lower now. And then maybe the cash on hand that they have is also lower, because maybe the accounts receivable that they're collecting is a little bit later from some of their segments. So the ability for them to actually buy smaller startups or any other companies might be a little bit more limited, as well as the return profile. So this talks a little bit around valuation, which we'll touch on as well, where let's say the public markets were once valuing startups at 10 times revenue, and now the market's valuing it at 5 times. How does this change the return profile of what our startups might be able to sell for if this market persists? And the last thing is around opportunity cost. So let's say I'm a family office and I see that I have $100 to invest and the public markets are liquid, means if I invest at any time, if there's volume, I can cash out. And now there's a 25, 30% discount on the public equity side. So would I rather invest in the public markets where maybe I can double my money in a year and have kind of clear sight into what I'm investing in and what the returns are going to look like? Or would I rather invest in a venture fund now, have kind of similar returns, but over a 5 to 7 year horizon where it's very illiquid? Like you don't just invest in a startup and then kind of have the money come back out the other end. It has to be acquired, or there's a secondary sale, or hopefully the company goes public. And only then will the funds be liquid, as in the investors into venture funds will get their money back. So there's a huge opportunity costs because the market is down so much, and these investors are kind of deciding, hey, like what allocation should we put towards into this liquid discounted market versus venture. And the next trickle down effect is around your customers. So the customers will be fighting their own fights and kind of putting out their own fires and making sure that they stay alive. And that'll take precedent over the problems that you're trying to solve. The procurement pipelines will also be kind of slowed down because the new purchase will be backlogged. They're not going to have like a couple $1 million to allocate to innovation, for example, anymore. And only the most important solutions that solve immediate needs will be approved. That's why we really like to see kind of workflow automation tools and core business unit functions being automated, just because those are a little bit more recession proof. It's not just a line item for an innovation budget, for example. And then they'll definitely go into buy versus build mentality. They're going to look for the highest ROI solutions where they have a very high impact on the business, and it preserves their working capital, which is their kind of operating cash, as well as their human capital. They want all your customers want the people and the cash to be put towards and spent on the highest return projects. So if you're just a nice to have resource, like they're not going to really invest and spend into your product or solution just because it's not mission critical. And their mission critical right now is to survive. So if you don't help them survive, they're not going to spend money on you. And now talking about the company hierarchy of needs, like if you look at any venture-backed startup, the foundation's almost always capital. Capital is needed to hire people to scale and build your product. And then once you have your product, you need capital that trickles down into investing in sales and marketing teams. And then you get to scale, and then hopefully you get into profitability at scale. So without capital, it's very hard to do some of these things. And some are saying that there's a huge kind of arbitrage in young technical founders because the burn is low and they're able to build a lot without too much capital. And for customers, if they can't even manage their own capital, how are they going to invest into your products and help you kind of increase your sales and marketing? So you have to always think about where the foundation of every business is at, which is almost always capital, and how that trickles down into the day-to-day operations of your own business. And a lot of people have been asking about fundraising implications. So capital raise, I was talking with Emily before this, like it's kind of been changing day to day, week to week, depending on the fund. But kind of early stage deployment, some funds are still very active. Some funds are kind of on a week or month kind of investing break and waiting to see how this environment shapes up. And this is because of a couple of reasons. So the first is around they don't know how these businesses are going to change. You might have to kind of change your burn, change the product a little bit to really hyper focus into being a must-have product for your customers. So the business risk is high. The second thing is around capital risk. As I mentioned before, some funds are being told to stop doing capital calls for a little bit. So the ability to cut a check is a little bit tougher. and around valuation as well. So as I said before, let's say you're a $10 million business from a revenue perspective, and you're looking to either raise a round or sell the company. If the public markets are pricing businesses at 10 times revenue previously, and now it's at 5 times, you might see a half cut in valuation in your round size or your exit price. So those are some implications that to keep in mind when you're looking to either fundraise or to sell the company. So the last thing to note here on a positive note is that some of the best startups were actually built during downturns. Google and Salesforce, those were built during the dot-com bubble. And if you think about those two solutions, like CRMs, everyone's going to need a CRM to keep your sales organization alive and keep track of all your customers. And Google is alive because everyone's still searching and they need ads. So there's a lot of those core sticky businesses that have kind of seen great success over the past couple of decades, and some of the other investments and companies that have come out of the financial crisis have been great too. So Stripe, for example, like everyone needs a payments platform, and that's probably going to stick. But from an Airbnb perspective, this has had a huge impact on the travel and tourism industry. So they're not doing as well right now. But again, like this might be a short-term blip in the economy, but who knows? But a lot of these companies have been built during huge distressed times. And these are high quality kind of mission driven founders that tackle great markets. So how should you plan as founders? What are some steps that you can take? What are some core areas that you can look for? Our view for any of our companies right now is to ensure that you can survive for the next 12 months. Look at the data and remove the emotion from your decision making. We talk a lot about this at the fund, where we have to kind of remove ourselves emotionally as investors as well as operators and businesses. It's kind of easier to pull off the Band-Aid than to rip it off versus slowly peeling it. So if you're going to make decisions, make them with data, and also make them with conviction, and don't be in this decision paralysis. So there's 3 key areas and buckets that we'll be going through today. The first being budget and runway review, sales forecasting, and lastly, alternative sources of capital. So the first is around budget and runway review. So this is around like your financials. So if you have like a head of finance or a CFO, or maybe you're a little bit smaller and it's just you as the CEO, these are some things that you kind of sit down as a founding team to talk about. So the most important thing is how much cash do we have in the bank right now? It's not how much cash are we going to have a month from now. And this is a huge kind of difference that we've seen founders look at businesses before, where maybe you're waiting on an invoice that's going to come in 30 days from now, or maybe you're waiting on this loan or that's going to get approved, or you're waiting on this credit that's going to come back. That's not guaranteed that it's going to come in. So the first place to start is how much cash do we have in the bank today to start with. The second thing to do is based on our current spend, so your current burn rate and no new revenue, how long does your business have left? That's one scenario that we encourage all the founders to do in their financial modeling. And based on the current spend in various scenarios on revenue decline, how long do we have left? So we'll talk about this a little bit in the sales forecasting side, but we encourage you to have kind of a base case, which is no new revenue, a bull or great case where it's what you've projected in the first place for how this year was going to go before the crisis, and then a bear or highly negative case where maybe you lose 25 to 50% of your clients. How long do you have left? Those are all cases that you need to review so that you can ensure that you have 12 to 18 months left for the business. And then the other thing to look at is booked versus revenue, revenue versus future revenue. So just because you signed a client today doesn't mean that they're going to pay the invoice 30 to 60 days from now. That's why we're talking about cash collections and cash-based accounting to think about how your cash runway is going to play out over the next little bit. So also forecast some of the churn assumptions where maybe the customers that have signed might not actually follow through as a customer because their budgets have changed. Those are all things that you have to think about from both sides. The last couple things are around, do you have your team fully optimized? So do we actually need everyone right now? What are we spending on today that's material and non-core to the business? From a headcount perspective, we've seen um, some interesting ways to optimize headcount as well as salary spend, where maybe some teams are taking 1 week off every month to reduce some salary costs, or teams are taking 25 to 50% salary cuts for the foreseeable future, just to kind of reduce burn for a little bit so that they can keep everyone on. Or some people are even switching to part-time. So there's some ways that you can hack around this, but if you really do need to make some layoffs, and it fits within the plan, then that's something you might have to consider. And then some like nice to have spending includes like stuff that you've planned for, maybe some marketing budget that isn't going to have a necessarily high ROI into sales right now because people don't have the budget to buy your service or your product. Those are all some things to consider when you're looking at the things that you're spending on. Some more specific budget line item review things are around external suppliers, like what are some projects that you have lined up that you can reduce or postpone. Same goes for product and R&D, where so what are some internal engineering projects or product that you have kind of investing in that you can postpone and to preserve cash. Yeah, working hours and then founder salaries is something that you can also think about. Is there any flexibility here to support the survival of the business? Um, those are all things that we suggest companies to look for, but obviously the biggest expense for any startup right now is salary. So that would be something to consider reevaluating when you're looking at the budget. So the next thing we'll go over is sales forecasts. When you're reviewing your runway and milestone goals, as I mentioned before, play out multiple situations so that you have kind of all the ducks lined up into what we need to do in each scenario. If things go well, hey, we don't need to do anything. If things don't go well, then we need to do something. So you don't want to be 3 to 6 months from now realizing that you're almost out of cash next month and now you need to make cuts. You want to have everything planned out ahead of time where you know, hey, if next month or at the end of next month, the sales aren't happening, the situation is getting worse, then we have to make changes from a burn rate perspective if we want the company to survive. And if things go really ugly, what does the company look like then as well? Is it just the founders that stay on the business and kind of weather the storm for a couple of months? And then when things go back a little bit, then we hire people back. Those are all things you have to think about right now and not just push it down and kick the can down the line and evaluate later, because by then it'll be way too late. Some other things you can try around like adding a quarter or like 3 to 6 months to your sales cycle. With the enterprises now, as we mentioned, procurement pipelines are going to slow down. They're going to prioritize different things, and the sales cycle for you is definitely going to change. And maybe you reduce the close rate by a little bit too. Are you still in business a year from now? There's a lot of factors that play into budget and sales forecasting. So feel free to reach out if you have any more questions or you want some insight there. Some other things you can do are around asking customers right now if they want to hold the subscription for a period of time so that they don't fully churn, or if a discount would help them continue using your tool. Just because a lot of things can change internally, and you want your customers who are getting value out of it to continue using it and to be able to return as full customers later on when things settle. The other thing is around evaluating near-term and long-term sales opportunities. So Matt, our partner, suggests that you should prioritize short-term closes where you can have a quick win, get cash in the bank, and make sure that you keep the business kind of funneling, versus allocating resources to longer-term deals that might close like 12 months from now, and you have no idea what the world's going to look like then. So focus on what you can control and what is kind of near term versus long term. And the last thing is, if it's not a huge cost to you, is there a possibility to offer your product for free during this kind of downturn and crisis? We see a lot of remote work and other types of tools be offered for free to a lot of institutions, and this builds a lot of goodwill with your customers going forward. And because there may be a trickle down in a material way to sources of capital, which is like venture traditionally for startups. It's a great way to kind of mitigate your own risk from a cash perspective and evaluate alternative sources. So for there's a lot of options around venture debt from either SVB, or there's a lot of the Canadian banks that are offering venture debt. I would definitely highly recommend like talking to them. BDC also has a great offering right now for some of the early stage startups. That is a great alternative as well. You can also look at small business loans. There's credit lines, or even you can even go into your existing investors if you have them and ask them if they're interested in doing an insider bridge round. If you have access to cheap capital and it buys you 6 to 12 months, our advice is to actually do it now. You don't want to wait it out for 3 to 6 months where the capital might be dried up, and let's say the economy even goes down even more, and it's even harder for you to raise, and it pushes it out another 12, 18 months. Like, that's a bad situation to be in. So the advice is to try to get a clear 12, 18 months of runway for your business today, just because you have no idea how this is going to pan out for the next little bit. So the last note that we'll share, this is from I think like a school superintendent or something like that, but I think it's really relevant to our situation as investors, as well as for the founder side. So you'll never know if you overreacted or did too much, but it'll be very apparent if you underreacted or did too little. So that's why we encourage everyone to act now and make sure that you do all the work needed to prepare and kind of make those decisions now versus wait it out and underreact and then play it by ear and wait and see how things happen, just because by then it's going to be too late. Burn's going to be too high, capital won't be available, and customers might not be willing to spend anymore. So there's a lot of factors that are up in the air that you have no idea are going to shape out. So our suggestion is to act now. Yeah, that kind of wraps up the presentation, Emily. And we can open up for questions and see if you have anything to ask.
So I haven't had any questions yet, but I would welcome everybody to send us questions on the YouTube comment area, and we'll be reading those questions aloud to Dominic. They can be general questions, or they can be questions more specific to your situation. We'll wait a few minutes and see if we get any from your folks. Thank you.
Yeah. And Emily, did you have any questions?
I think that was a super awesome presentation. I don't have any immediate questions. And I know you spoke a little bit on if companies are thinking about fundraising now, how they may be better off actively looking at other options.
Yeah.
If they're already in the middle of a fundraising round, what are your suggestions for exactly what they do? Should they try to continue down the path with the folks that they're talking to? Yep. Or should they move on to other things?
Gotcha. So if you are in a current fundraising process, if you have a term sheet, you have to prioritize that and communicate with that investor and see if they're willing and able to close them. And if you're kind of starting off the fundraising process, I would touch base with all the investors that you're connecting with and just see where they're at in terms of their fund strategy on what they're doing. So depending on the firm, either they're still actively investing or they're taking a pause for a couple of weeks or a couple of months, and schedule follow-up chats and stuff in people's calendars to have the conversation when things sort of settle down as well. But if you're starting to fundraise now, there's only a few kind of select funds out there that are really, really active still. And for the most part, and I'm not going to speak for all the investors, but for the most part, everyone's kind of taking a small pause. But if you should definitely over communicate and try to touch base with everyone that you have a relationship with and gather your own sentiment around like where things are actually going to go. I think most people are very clear and transparent here. It's not just because everyone needs that information. And the last thing that I'll add to that is if you're kickstarting the fundraise now, I would go back to the budget side and see like, hey, what if we raise half of what we expected to raise? Or what if we aren't able to raise at all? How does that impact our runway situation? And how does that impact the business? The other things to mention on that would be be prepared to do a down round or a round at the same valuation as the last round if you are in a bad financial position. So if you only have 2 to 3 months left of runway.
So we do have a couple of questions from the audience right now.
Okay.
First one says, interested if you have any insights about how this affects construction industry as a prop tech hardware startup providing solutions in the space. Um, so I think they're looking more specifically, just to summarize, about if you see like the current economic situation and fundraising affecting construction and prop tech. This company specifically is working on new builds and retrofits.
New build and retro. So I don't have a clear answer for that, unfortunately. So I'm not going to try to answer a question that I don't have a good answer to. So unfortunately, I don't have anything there. But I would always think to like where the cash comes from your customers. So if it's kind of construction projects funded by the government, how is that impacted throughout this crisis? Have there been any news around that? And I would reach out and do some analysis on if there's any construction or hardware companies that have been funded recently. And that'll give you a good pulse on the market on if people are getting funded, as well as if there's going to be any implications on where your customers are going to get the budget to buy stuff from you.
Awesome. And there's one more question right now. It says, what are your thoughts on VC's interest in esports and gaming companies since currently there is no content coming from sports, movies, and entertainment industries?
Oh yeah, no, that's a great question. So with the esports side, the investors personally are getting a lot more exposure to it because they're at home with their kids for a prolonged period of time now, and they're seeing and actually testing out the games themselves because they have all this time and family time with their kids. So definitely, it's a great market shift for the investors who might not have understood it before. And now they're definitely a lot more bullish because they see the opportunity if this crisis persists. But there are funds out there that specifically focus around esports, and there's a lot of funding in that ecosystem. So I play kind of video games myself, and I'm bullish on the industry. So it's definitely great.
Awesome. So there's another question now. There's a couple more questions feeding in. The question is there an advantage for investors in making investments in seed or pre-seed in brackets R&D stage versus seed and Series A or scale stage? For example, they have access to more talent, tax credits, and without need to sell for 12 to 18 months.
So it's hard to say like if there's a quote unquote arbitrage opportunity for like a pre-seed seed stage. Obviously, if you're a pre-seed to seed stage company or like early stage company, your burn is like lower, and you're probably sitting around like I don't know 35 to 100K in monthly burn. And if you just raise around for $2 million, you're good for the next like couple of years. So just by the nature of those businesses and how small and low the burn is, and if they've raised capital, and if the founders are okay in reducing that burn, if they haven't raised a round to kind of wait out the storm. For the younger founders, again, like it's a little bit easier for them because they just because that's the nature of that type of company. But for a late stage company that maybe has like I don't know like 30 million dollars or like $3 million of burn per month, that becomes a little bit of a different situation if you're a little bit low on cash. So um, I can't say if there's a huge arbitrage in early stage, but by the nature of the business in a cash requirement to run it, it's a little bit better in some ways, but a little bit worse because now if you're a seed stage company and you're kind of focused on product, and you don't really need to sell too much for the next like 12 to 18 months, you have to hit some kind of bar out of this crisis and really stand out among the crowd, because there are going to be a lot of kind of those pre-seed companies that are early products with some free users. Like now the question is how are you going to scale that business and become a positive cash flow company. So it depends on the situation for sure.
So the next question reads, I'm starting an events company currently. any thoughts or insights on how this industry could be affected or may shift online?
Yeah, like all the events that we were going to go to have been canceled. So definitely a huge impact in the short term. In the long term, again, like I have no idea how this is going to play out. Like, so I don't have an answer on how the industry is going to shape up then. But I think I would try to gather sentiment around your target user base and ask them like, hey, if this settles down, like when would you be comfortable going back to events and conferences? Always kind of go back to the core user that you're going after. And so I don't have a great answer for that. But my guess is that people are going to have a bit of a negative stigma against going to um, crowded events, and people are going to be very afraid of kind of shaking hands and stuff like that. So only time will tell, and the human nature side of it, I would always go back to your user and customer base and ask them like what they think. So I don't have a clear answer there.
And so the next question, this is currently our last question, so I'll give it to you. And if anyone else has a last question they'd like answered, if they could please start typing it now. The question reads, any insight into international VCs and investor outlook? We raised our pre-seed internationally in the UK and have been exploring outside of North America, looking for funds who haven't been hit yet.
Yeah. Um, So again, the answer depends because internationally, it depends if those funds have made bets virtually, as in have they closed a deal through Zoom conferences before? Do they have comfort writing a $5 million check, not being able to see you face to face, or be able to do customer calls and talk to your customers, or reach out to their contacts who are facing their own fights right now? Like, it's tough to say, but there's some funds that operate fully remote, and they've cut checks that way, and they operate internationally. Um, so it depends on the investor. It depends on if what you think and imagine that diligence process is going to look like. If they need to do like 5 customer calls and all 5 of your customers haven't even responded to you in the past like month, like it's going to be tough to get through that diligence process. So um, it depends on those factors, but I would target funds that have or the ones that you've talked to who have closed deals virtually before, just because there's no clear view into when we're going to be able to meet in person, especially internationally, in this climate.
Awesome. Thank you so much for that, Dominic. I think that wraps our questions.
Okay.
Folks, if you had other questions you didn't get a chance to answer, please send them to me via email. Everyone who has the link likely has my email, or please send it to DMZ's general email and we'll try to. Oh, it seems like one final question got in as I was squeezing, so we'll squeeze that one on.
Yeah.
It's specifically says, do you have thoughts or insights or experience in the ed tech space? And with active VC funds, what's your rough estimate on timing from first meeting to close?
Ad tech or ed tech?
Ed tech, education tech.
Ed tech. So ed tech, especially like virtual kind of ed tech companies, have been doing extremely well right now because the education systems have been operating in such an archaic way where they are not even close to being prepared for a crisis and pandemic like this. So I think a lot of the strategy from the top is going to change and incorporate virtual education opportunities across like K-12, higher ed, all that kind of stuff. So definitely huge opportunity there. And the second question around timing, we would say fundraising processes like typically take 3 to 6 months at least. If it's a very competitive round, maybe a month or two, from time of cash to from time of first meeting to cash in bank. And it also depends on the way that you're raising. So if you're raising like a safe note or a convertible note, for example, there's less legals involved to be able to issue those investment securities versus if you're doing a priced equity round where you have to go through like a subscription agreement, investor rights agreement, like all that kind of stuff that the lawyers have to draft up, that take a little bit of time. So it depends on the round type. So if it's and it depends on the round size as well. So if you're raising like up to 250, 500K, all from like one or two, like either pre-seed funds, or you have a couple of angels that are stringing together like 150K in total, like that'll be pretty quick to raise. But if you're looking for like a 3 million to like $15 million round, like I would say it might take like 3 to 6 months for sure.
Awesome. Thank you so much, Dominic. I'd like to thank everybody for tuning in. And I would welcome them to join us again on Friday for our workshop with Michael McCarthy. But Dominic, we really appreciate what you shared with us. I think it's been really informative. And the comments say great gratitude of thanks for the answers to their questions. So thank you so much.
Yeah, thank you so much for having me today. And please feel free to reach out if you have any more questions. And then I'm going to send Emily the presentation afterward to distribute as well.